Larry, we just heard Eunice talking about some of the flashpoint issues happening in China and in Hong Kong. We know that the markets here in the U.S. are still hovering near record highs. Is this a scenario now where the world economy, the world market, is all contingent upon what happens in the United States?
Well, think about Dom. Like about 12 years ago, everybody was talking about what's called decoupling, where there were problems in the U.S. and globally there was strength. And now it's the complete opposite. You've got problems globally and strength in the U.S., strong dollar. And I think what's going to happen over the next 6 months is a big, big trade. This is going to be the trade for the next a 2020 trade, a rebalancing of the global economy where the global economy strengthens relative to the U.S. and you have capital that will flow from the U.S. into global assets.
So if this is the case, how important is what's happening in Hong Kong with China and the tensions there going to play into this narrative overall? Is this a scenario where we could really see some kind of a downside event triggered globally because of what's happening in Hong Kong?
Well, it's really going to trigger a problem in the U.S. I mean, you've got this bill. We put a note out to clients last week. You've got senators and congressmen really taking the wheel out of the White House's hands. I mean, President Trump's going to try to do a trade deal. It's a skinny deal, but net, the pressure that's going to come from Congress, going to come from Democratic candidates. They're going to try to make Trump look soft on China. So there's this bipartisan effort in the United States to lay the hammer down, and that creates uncertainty, at least for U.S. markets.
All right, so that uncertainty right now is one of the reasons why the Fed did take the actions it has over the course of the year and cut interest rates 3 times. The interest rate environment right now, generally speaking, is it still supportive of what's happening with the United States with regard to the economy? And if not, what needs to happen to that interest rate complex, and where could we see some flashpoints there?
Well, you and I were talking a year ago, right about now, in November, December, and I made the point on this program that the beast in the market, that serpent in the market, was going to break the Fed over its knee. Credit risk was really rising dramatically, and that's what happened. The Fed not only caved on rate cuts, but they dramatically caved on the balance sheet. They were literally doing $50 billion a month of tightening. Now they've literally undone about $400 billion of that. But here's the thing: everybody says, Dom, don't fight the Fed. I mean, how many times have you heard "don't fight the Fed"? And I have a question for you and for all of our people watching right now. Why are people in the bond market, especially in the junk bonds, why are they fighting the Fed? For the first time in literally since Lehman went down, for the first time, when we have an accommodative Fed, you've got bonds that are dropping 20, 30, 40 points in high yield. And a lot of them, I mean, it's really a symphony of idiosyncrasies.
But okay, so one final point here. I can understand what you're saying about the general tone of the bond market and high yield, but those idiosyncrasies are only in certain parts of that bond market. If you look at, generally speaking, take a look at these ETFs that track high yield debt, and they're not rolling over by any means. So is this really a scenario where we feel as though the credit markets are signaling something bad ahead?
Well, you know what happens, and we saw this in 2007 with the mortgage market. There were idiosyncratic pockets of risk. And one by one, as they grew, it was a combination that it's what I call credit spread contagion, and we talk about in the Bear Traps report. So this has moved, just in the last month, this has moved from tightness in CLOs, loans, triple Cs, and now it's seeking into single Bs. So. And think about it, the banks, the Fed obviously had to cave on the balance sheet. The banks aren't stressed, but the ability to finance bad assets, all this problem with WeWork, as you have default after default and bond after bond that's under credit problem. Right now we're seeing and this is the most important part of the interview, we're seeing underperformance of U.S. bank CDS. So look at right now, Citibank CDS versus the European banks. It's starting to widen. So that tells you that there's some type of credit spread contagion that's working its way through U.S. markets.